Hello traders. Today we want to discuss what is position trading. Question: what is position trading? The time has come to reveal all the secrets about position trading. What is position trading? What one must know if one wants to become a position trader. All right. The first thing first, a position trading is a medium to long-term trading. One is entering the trade, one is buying or selling a financial instrument, and one is holding that position for a medium to long term. One is holding that position for at least 1 month. All right. So when we are talking about swing trading, a swing trader can hold a position for a week, for 2 weeks, or for 3 weeks, or even 4 weeks sometimes. But typically, a swing trader may close the position after 2 to 3 weeks. But when one is a position trader, one is holding the position more than a month, 2 months, 3 months, 5 months, 6 months sometimes. Even in some cases, position traders can hold a position for a year. Well, we have seen recently that gold was going down for a few years. Position traders that are buying gold will hold gold for a long period of time. But as a position trader is holding a position, what usually takes place, practically speaking, a position trader will open 2 or 4 or 5 positions. So for instance, if they are position trading the British pound, US dollar, they may open 3 or 4 positions. Because they're about to hold the position for more than a month, they will be closing some of those positions as the price is going up or down. So suppose you open 3 or 4 positions, all right, and position trade, and you notice that all those trades are profitable, you may close 1 or 2 of those positions and let the rest of your positions stay in place until you notice that there's no room for the price to go up or to go down. So a position trader is a medium to long-term market participant. He or she will hold that position for more than a month, contrary to a swing trader that can hold a position for a week or 2 weeks or 3 weeks or so. All right, is a medium to long-term market participant. This is the first thing you want to understand. So when somebody asks you what's the position trading, it's a medium to long-term, trading. When one is holding a position for more than a month, one is a position trader. All right. I will discuss also what is a classic position trading. All right. In this tutorial, at the end of this tutorial, you will be able to understand and to know everything about a classic, position trading. When we are talking about classic position trading, we are talking about those market participants, especially most of them are technical traders that are combining their typical technical traders, and they are combining the technical analysis with the fundamental. And those classic position traders use the quarterly charts. All right. So if when you're applying for to become a trader in a firm, a hedge fund is want to employ you, ask you what is a position trading. Have you ever had a position trade before? Okay. The classic position traders use the quarterly chart. You need to know that. Very important. Quarterly chart. All right. I'm talking about classic position traders. All right. A position trader can also use the yearly chart. But a classic position trader will mainly focus on the quarterly chart. He or she will look for trading setups on the quarterly chart. All right. The next thing I want to explain to traders, talking about position traders always combine the technical analysis with the fundamental. So if you are thinking to become a position trader, but you don't want to perform a fundamental analysis, position trading is not for you, because you are going to hold a position for 2 or more months, or 4 months, 5 months. It will be completely crazy not to check the economy news, not to check the balance sheet, not to check the fundamental. So you think that the financial instrument that you are about to sell and hold for more than a month, for more than a quarter, for more than 6 months is going to go down. You are selling it. There should be fundamental reasons why the stock or the commodity or the currency should go down for at least 3 months or more, should go out for more than 6 months or more. So a position trader will always combine the technical analysis and the fundamental. The hedge funds, all right, the big financial institutions, the banks, are usually position traders. They hold position for 2 or 3 months or 5 months or sometimes even 6 months. All right, so those classic position traders will look for trading setups on a quarterly chart. So how do the position traders trade, especially the classic position traders? So here on a quarterly chart, we see that the price went down and then pulled back. See, this is very interesting. This is beautiful setup here, a double bottom chart pattern. You can see that the price was going down quite fast, quite bearish here, and then it rallied up a bit. And as it's coming down to form the double bottom chart pattern, there was no much volatility here. You can see the size of the candle. It's telling that there is no more demand to sell the British pound US dollar currency pair before we see this double bottom chart pattern. So as the double bottom chart pattern is being formed, it's not completed. You can see that it couldn't break above the neckline or the nut. All right. But as the position traders notice that the price breaks above, I'm going to explain to you what's happening here. It breaks above the common central line here. They will use what we call a top-down trading method. So a classic position trader that has identified a trading setup on a quarterly chart will go to the which time frame for the signal? He or she will go to the weekly chart. So classic position trader look for trading setup on which time frame? On the quarterly time frame. They will look for the signal on the weekly time frame, and they will enter the trade not on the 5 minute, not on the 10 minute, but on the 4-hour time frame or 2-hour time frame. So quarterly chart, weekly chart, 4-hour time frame. So as they see a trading setup on the quarterly time frame, they go to the weekly chart for the signal. So at this point in time, they will go to the weekly time frame. They will see that the weekly candlestick bar close above this trend line. They are looking for a clear-cut signal, break above, retest for a bullish trading setup. Above, break above, retest a key horizontal level, or break above, retest a trend line. All right. As the signal is fired on the weekly time frame, they go now to the 4-hour time frame or 2-hour time frame to enter the trade. You want to understand how the position traders are trading. They are looking first for the trading setup on the quarterly time frame. They will take the signal on the, they will wait for the signal on the weekly chart, but they will enter the trade either on the 4-hour time frame or 2-hour time frame. This is how the classic position traders are trading. All right. Look for high probability trading setup on the quarterly time frame, and then wait for the signal on the weekly time frame and enter the trade on the 4 or 2-hour time frame. Now, before a position trader will engage in any position trade, he or she by all means will check the fundamentals before placing the trade, unless they are crazy position traders. Hedge funds are smart market participants. They use fundamental. Big financial institutions, banks, or even private investment companies are smart investors that are combining the technical analysis and the fundamental. I have to say that if you are just one of the purest technical trader that does not care about the fundamental, then the position trading is not for you. All right? You are holding the position. And now one more thing I need to clarify with traders. The position traders use option. So if they want to buy, they will use call option. So they do not use like us a stop loss. All right? They will buy call option. So they are thinking that the British pound, US dollar will go up. As the signal is fired on a weekly time frame and they time carefully, those are sophisticated market participants, they will check on the 4-hour time frame or on the 2-hour time frame that an entry is now in place. Then they will go and buy their call option if they think that the financial instrument is bullish, or they will buy a put option if they think that the financial instrument is bearish. And then they will hold that position for more than a month, sometimes up to 6 months. So a position trader that enter the trade here, you can see that can remain in the trade up to 4 months, 1, 2, 3, 4. But he or she will open more than 2 positions and he will close some position as the price is going up. But in all cases, he will be combining the technical analysis and the fundamental. The next thing that one wants to know, talking about what is position trading, the position trader, especially the classic position traders, will never, repeat, never enter a position trade, all right, while, okay, a quarterly candlestick bar is being formed. So they always they usually, most, in fact, they always, unless they are crazy, all right, they always enter their position trade when a quarterly candlestick bar is closed. So you see here, as this candlestick bar is closed, all right, and this one is underway, so one candlestick bar on the quarterly chart must close. And then you go on a weekly chart, so you are expecting this. So you see on a weekly chart, few candlestick bar will start appearing on a weekly chart, and you are looking for the signal. A quarterly candlestick bar must close before one will attempt, okay, to enter a quarterly okay, trading setup or a position trade. So the point I'm making here is that your trading setup will be in place after a quarterly candlestick bar is in place. All right? A quarterly candlestick bar is closed. So typical classic position trader, after this candle here is closed, then they will initiate their position. All right? They are combining the technical analysis with the fundamental. They are looking for technical trading setup on the quarterly time frame. They are looking for technical trading signal on the weekly time frame. And they are looking for technical entry on the 2-hour or 4-hour time frame. So they are combining, okay, the technical analysis, but they are also using a top-down trading method, a multiple time frame trading method, quarterly time frame for the setup, weekly time frame for the signal, 2 hours or 4 hours for the entry. And they will hold the position for at least 1 month. All right? A position trader is a medium to long-term market participant. In some cases, a position trader may hold that position for some time. So here we have this red declining channel. You can see that the price went down. It was displaying. So there was this high here, followed by this lower high on a quarterly time frame. All right. Now you can see this candle here. You see how this candle went down all the way here. But at one point, it was on the edge. So a position trader may take position after the price is retesting from a new lower low. Now, he went back to retest the edge of the declining channel. He or she will implement a top-down trading method to trade it. Here we can see a double bottom chart pattern trading setup. Now we have a higher low, a double bottom, a higher low after a double bottom chart pattern. It's a high probability trading setup. Here again, this is a trading setup for a position trader. In all cases, they will combine the technical analysis with the fundamental. A position trader will not buy or sell at any price. So they usually enter a trade around key levels. They buy at a specific price level and they sell at a specific price level. All right? So they analyze the fundamental, a thorough fundamental analysis, confirm that this financial instrument is about to go up. Okay, that's the first step. Second step, they look for trading setup that is in place, and then they implement a top-down trading method to trade it. They open 2 or more positions, and then we'll be closing some position as the trade is becoming profitable. A position trading is not for children, so to speak. A position traders also pay attention to market cycles. They use the area wave cycle, multi-wave, plus corrective phase. Position traders also use predictive fractal patterns. In fact, the most sophisticated position traders use predictive fractal patterns. They use market cycle because usually, all right, so if a cycle, a bullish cycle is about to begin, it will begin when a fundamental are solid in a viable market environment. So market environment is viable, is bullish, okay? End of a bearish cycle. Now market sentiment is changed, end of bearish cycle. Market sentiment become bullish, fundamentals are improving, position traders are taking positions to catch the new bullish cycle that is about to begin. Position trader will also sell if they know that a financial instrument is overbought 5 times or more the book value, all right? Or a financial instrument has reached the end of a cycle in an uptrend, and they are looking to sell. Talking about the end of the trend. A trend is ending. So we know that a cycle for, I don't want you to get confused, because when we are talking about area wave cycle, it's formed on the trending phase and the corrective phase. But when we are talking about a cycle in this case, we are talking about the trending phase only. Financial instrument went up, it's about to go down, they want to sell at the beginning of the corrective phase. Financial instrument is about to begin a bullish trend or a bearish trend, they will buy at a specific price, they will buy at around key levels. Apart from the classic position traders also use the yearly chart. So for the yearly chart, they use the yearly chart, they look for trading setup on the yearly chart. They will wait for the signal on the monthly charts, and they will enter the trade on the daily chart. Top-down trading method, yearly chart for the trading setup, monthly chart for the signal, and daily chart for the entry. Classic position trader will use quarterly chart, weekly chart, 4 hours or 2 hour time frame. In all cases, they are using, okay, they are combining the technical analysis with the fundamentals. Remember that position traders are smart market participants, and they will always buy around key level. They use the candlestick patterns on the quarterly charts for trading setups. So if you want to become a smart position trader, here we have one, you see here, this candle, these 2 candles here is a bearish setup here, all right, after this one here. So these 2 candles plus this bearish candle here is a bearish candlestick patterns, all right. Here we have a bearish engulfment, price went up. Now we see this bearish candlestick bar that closed below the low of this one here. So price went up, it's a bearish engulfment. So on a quarterly chart, those position traders use bullish engulfment, bearish engulfment, and other candlestick patterns. They use also cycle and normal trading setup that we have here: double bottom, a higher low after double bottom, or double top, and the low at the first lower high after a double top. In all cases, they use a top-down trading method, multiple time frame trading method. They will check first the fundamental before initiating the technical analysis. All right? A position trader is a medium to long-term market participant. They wait for a quarterly candlestick bar to close first. I hope this clarifies a few things about, reveal a little bit more about position traders, how they intervene in the financial market. Remember, they always will open more than two positions. And as the price is going up, they will be closing some position on the way. That's why you see sometimes a pullback. So if they see a pullback in the bullish trend, all right, another setup, a higher low is in play, they want to buy again. I want to remind traders that most position traders are usually what we call the first buyers. So for us that understand Elliott wave, the first Elliott wave is the signature of position traders. They are holding position. They believe that a trend is about to begin, and they are the early buyers. They are the first buyers. They usually buy during the consolidation phase. So bearish trend, consolidation, they are accumulating. Okay, that's what we call accumulation. They are buying over time. They are buying gently. All right? So, because if they want to buy millions of shares, they don't buy in one day, they will be buying gently, until those orders are filled. This is about real traders. But remember that position traders will use call option or put option. This is to control the risk, because the only thing they have to worry about is not being taken out of the trade straight away because of some short-term volatility, but they are using time expiration. They're holding a position, all right, for a year or for half a year, for a quarter. So they buy options that will allow them to hold that position for a long period of time. As they have already checked the fundamental, they are holding positions. All right. If you have any question or suggestion, put in the comment section. And in due course, I will be busy recording another video to answer your specific question. The main difference between a position trader and a swing trader is just a swing trader will hold position for a week, 2 weeks, or 3 weeks. All right. And then they will cash out and they will look for another swing trade again. On the other hand, position trader, you will hold position for minimum. So if you know how the position, you may say, George, I'm not a position trader, I'm a swing trader. As a swing trader, you want to understand how the position traders are trading, so you may take advantage of their trade. So they are holding position for a long time. If they are buying for a long time, you want to take advantage of the pullbacks. All right. If they are selling for a long time, you want to position yourself and give priority to bearish signal. If you are trading the financial instrument that they are selling, you don't want to step on their feet. All right. All right. They are big market movers. I hope you have found this video also useful, and will put into use to make excellent trading and investing decision. A position trader is also an investor, a medium to long-term investor, but they are more sophisticated investors that are not using only the fundamental analysis, but they are combining the fundamental analysis with the technical analysis. They use Fibonacci, they use Elliott wave. Especially hedge funds are position traders. They are smart position traders. All right. They are investors that are trading. All right. They are holding position using technical tools. Okay. A position trader can use a divergence, bullish or bearish divergence on the quarterly chart. But he or she will always check first the fundamentals. Without that, he or she will not place a position. And as they enter the trade, they are quite defensive. They protect the trade. All right, there are more to the behavior of position trader, and I will be posting another video to show you how position traders defend their position. All right, they defend their position. Now, this has nothing to do with market manipulation, because if you have all right, $20 million position or more, are you going to leave it there for ordinary trader to mess up your trade? No, you will not. You need to be defensive. And there are measures that they use to defend their positions. That's why it's good for day and swing traders to understand how those market participants are trading, are buying, are selling, are holding positions. All right? This is the end of this tutorial. And until the next time, enjoy yourself and be very happy. We are the GSTWSYS008 traders talking about what is position trading. Happy trading to you all, and speak to you soon.